Well, hello everybody. This is Seth Martin, and this is the Middle Class Investor this week. I want to thank everybody for coming in, and I apologize for not announcing the week before last that I wouldn't be doing a recording last week. I totally slipped my mind, but ended up going to Dallas for the Independence Day holiday and having a good time with family and stuff like that. So, anyway. Um, last week and this past week were big weeks. I mean, we had two. You can see here we had two just ginormous weeks in the S&P 500 right here and right here. And you can see I was expecting to kind of see something like this. Now we still could get this. Um, I was guessing or looking at the probabilities and guessing that the trend terminated right here, but maybe we're terminating right here. I don't know. It's not a great probability here because this is more typical where you get these dojis. When you have these big white candles, we could be in the middle of a move that's going to probably not stop until we get we take out this old high here. And I mean we're kind of there now. I mean we're if you draw like a decision box here, you gotta maybe a little bit higher. Maybe we get an intraday high, or an intra-week high, and then it starts to sell off. But I don't know, man. This is the strangest and hardest to read market because this was such a shallow pullback. I mean, it's highly unusual when you have a move like this to get only. I mean, we can go look at what that move is, but I want to say it's like it's not even 23% or something on the. Let me go to the charts and let's see. Let's just zoom in here, and I'll move this down a little bit so it's easier to see. And what I want to do is I just want to. Well, I can't move it down that far. I just want to take the Fibonacci tool, go to Fibonacci retracement, go to the bottom of this move. If I can get it to click, there we go, and go to the top here. See, I mean, just 38% retracement. I mean, that's more like a kind of a wave 4 retracement. So maybe this is a larger wave 4. I don't know. I mean, it is very difficult to read. I think where I'm going to spend most of my time today, I want to talk about the broad market, but I think where I'm going to spend most of my time today is in the bond market because I think the bond market could create the catalyst for the stock market to sell off. So, but suffice to say, we had a pretty strong up week, and we still haven't made new highs in the S&P, but it's charging pretty good here, and doesn't look like it wants to stop. Now, I still would be very surprised and happy if this pullback did come into this area, because this is a more typical pullback. I think one of the things this tells me, because it didn't pull back all the way here, that this move is not going to be significantly higher. That's one of the things it tells me, because usually before the market goes significantly higher again, it's got to pull back pretty good. I mean, if you look here, this was a good move, and then a really deep pullback. We could go back and look at other places in the market, and it's always the same. I mean, if I measured this, I don't know, this might be 38%, but usually you get a pretty deep pullback like this move here. You get a move up, and then you get this deep pullback here. So I'm not saying it's not going to go higher. I'm just saying without a deeper pullback, it's not likely to go too much higher. But We'll see. I think it's definitely likely that we'll take out these highs. I mean, we're right there. I mean, these highs are right. Let's see. Let's put a. I think this is the high right in here on the S&P 500, 2134. So I mean, we're just a, you know, baby's breath away from that. So I think it's very likely you're going to see a new high. And based on my bearish thinking, it would be kind of interesting if it were like an intraday high and then reversed. That would give you a clear signal to, you know, be out of your 401k or out of the S&P 500 type index funds. Anyway, since we're talking about bond market, real quick, let's look at the 10-year. The 10-year made a new low. Wasn't expecting that either. You know, that's the way the market is, though. It'll you know, as soon as you think you know what's happening, you know, we were focused on this low right here, and of course we pierced that low on the yields. And I have another chart that shows another pattern that this could be morphing into, and if it is, it's very bullish on yields. So we'll take a look at that. Let's look at the very short term. We've been talking about, you know, as long as yields stay below this 0.035 area, that the Fed probably wasn't going to raise rates, and I think that's probably true. You know, I think the Fed got a little nervous with that. We had like an 80,000 jobs created number, I don't know, month before last, and this past report, it went all the way back to 287. So it could be that the 80,000 one was an anomaly, and maybe we're gonna, you know, maybe we're gonna continue around this 280 area, but traders still don't think that the Fed's going to raise rates, and that's what this chart's telling us. So until this busts out above here, like we've been talking about, even if it can do this. It can come up here like this and then pull back here like that. That's still going to signal the Fed probably to raise rates. That's my best guess. So volatility, you know, we've had an expansion of volatility, but then it collapsed right back down. And, you know, we talked about, I don't know if you remember, but I don't know, 4 weeks ago, we were talking about this box, and we were right at the edge of that. And I said, you know, if it jumps out of that box, we're probably going to get a pretty good expansion of volatility. But boy, they slammed it right back. So, this is, when you see something like this means there's a lot of complacency in the market. Complacency is usually a really bearish kind of thing. We'll see. I think we're going to make new highs, but I don't think they'll be that significant. You know, the UK left European Union. That was the big news. And if you notice here on the UK, we do have a higher low, and we've got an inside week here. So here was our previous low right here, and then we pulled back to a higher low, and then rallied. And then we had kind of an inside week here. So what you want to look for if you're trading the UK is next week to just close above this high right here. If we get a close above this high, you enter and you go long the UK. Now, sometimes this is difficult for people because they're thinking, oh, you know, the UK leaving the European Union, that's going to be bad for the UK. You know, the problem with news is you don't really know how it works out, right? And somebody does somewhere, but usually individual investors are on the wrong side of news. So that's why most people don't trade on news unless you're a very, very short-term trader and you've got, you know, some sort of Twitter, you know, algorithm that allows you to snoop Twitter and automatically enter trades and things like that. That's not what you and I do, so there's no sense in talking too much about it. So let's look, before we leave the idea of the bond market, let's look at a chart here that I think is pretty significant. This is the 30-year Treasury, and you can see this particular chart goes all the way back to 1996. And you can see here that yields have been in a steady fall since 1996, and actually yields have been in a steady fall for even longer than that. But you've got this triangle here, and the way triangles work is it's kind of the market coiling up like a spring, and then you get a blast out of this, to the upside or downside, depending on which way the spring is coiling up. Clearly, I think the spring is coiling up here as the market moves down for a higher move, and probably pretty explosive move. So a lot of times what will happen, the way you kind of look at these yield things, is you measure from high to low here. So if you're to measure from, whoops, wrong button. Let me zoom out a little bit more, and then just measure if you measure from here to here, so 2.53 minus 4.8 something, that's what is that? That's 230 or so. So what we would expect to happen then is we would expect yields to from this area here, which is just below 225, so let's call that 210. You would expect a 2.2, 2.3 move, which would put yields at what would that be? 4.4 in pretty quick order. This is usually a very pretty explosive move, so maybe to there in pretty short order. That's going to cause the Fed to do all kinds of weird things probably. So we'll just have to play it by ear. I mean, nobody knows the future. Again, that's not what we're doing here. So, but I think if you're in bonds or in bond funds, you got to really be thinking that that's probably not where you want to be. So the other chart I have here is the Wilshire. And the Wilshire is more broad index. It's a 5,000 5,000 stock index. And this guy's generic. I've talked about generic before. And the thing I want to point out on this chart, a couple things. Well, I don't want to get too far away from this. You can see there's a divergence here. So as the market was going up, the internal measures of the market were going down. That's called a bearish divergence. Now, will anything happen? There's no way to know, but it's just something to observe on the chart. Now, what generic is showing here is he's showing, maybe we go a little bit higher, maybe up into this area. But then once we move up into this area, he's expecting it to move down here on pretty short order. That's because this is the wave 4 low. A lot of times you'll get some sort of correction there, an ABC type correction, something like that. And then you'll get a pretty big move. So, we'll see. I think the market could easily go higher from here and take out new highs, which would render this count, ex-nay. So we'll just have to see, play it by ear, and watch the market and not get too hung up on what we think it's doing. And but the divergence thing I think is pretty important. I saw some divergences on, if you look here, this is on the SPX, the S&P 500. There's a divergence here on the RSI. You can clearly see it now. It looks like we might break out of it to the upside, but as of right now, there's a divergence. As the market was, from at this point, the market was, here and it was moving higher, but the RSI is moving lower, and then the market makes a new high, and at that new high, the RSI rolls over and goes down. Now it's at a new high, and the RSI is still below this diverging trend line. Again, it looks really strong. You usually don't see the market trend end on a candle like this, so would look for some dojis. I mean, you can see it back here. See these doji? These are all, where the range is real. The range might be long, but the open close range is very, very short. And that's what we're looking at. Let's go back to profit charts real quick and just see if there's anything else we want to look at. Treasury yield, short-term yield. The euro, we can look at the euro, but, we're going to look at the dollar in a minute. And so I'm showing the euro in kind of a triangle. Again, this is kind of a coiling up pattern, so the market tends to narrow. Whoops. Why is that doing that? The market tends to narrow. Huh. I didn't know that turned that on. Shouldn't be turning that on. It is, though, so let me try this again. Yeah, I don't know why that's turning that on. Anyway, the market's tending to narrow, and of course, the way this works is once it breaks out, usually these tend to be trend continuation patterns. So the previous trend, you can see, was down. So when this breaks out, it should break out to the upside. To the downside. So you kind of get chop, 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 and then break to the downside. So we should see the euro at new lows, i.e. the dollar at new highs. Let's look at the dollar. Let's go over here and look at the dollar real quick. The dollar's been choppy for a long time, but it does look like it's wanting to break out and move higher here, which, again, these are difficult things to happen at the same time. It's really hard for the dollar to move higher and for the market to move higher. That's generally not how it works. So, a lot of times when you have these things that are generally kind of out of place, it usually means there's big speculative money on one side or the other, and it's obscuring the relationship that's normally there. And Prechter talks about all the time. He talks about commercials and speculators. So large speculators have to register with the CFTC or whatever it is, and they tend to be groups like hedge funds and stuff like that. And large speculators, so he'll track how bullish or bearish large speculators are versus commercials. And commercials is just a word to describe companies that are in the business. So, for example, if I'm an oil company and I'm a commercial trader, that means that I'm looking to buy oil. Let's say I'm a refiner. If the price of oil gets really low, I might enter a lot of contracts for futures to buy crude oil for my refinery. But I'm not buying the crude oil futures so that I can turn around and trade them to somebody else. I'm buying them so I can take delivery of oil to run through my refinery. That's a commercial. A speculator is somebody who just thinks oil is going to go up and they're going to buy oil and trade it. And so what tends to happen is at these big turns, speculators tend to be wrong and commercials tend to be right. So if you went and looked at oil, for example, this point right here, these points right in here, here, and here, these are areas where the speculators were wrong and the commercials were right. So what was happening is the prices up here, and people that are in the oil business are saying, well, heck, I'm going to sell some of my oil because my production costs are this and whatever. So they're selling oil contracts at these levels because, it's a good deal, right? They feel like it's a good deal. Where speculators are just they're buying. They're probably buying right here because the trend is up, and they think the trend. They what they do is they take this little purple line here, this trend, and they extrapolate it out into the future, and they say, well, oil, by October of next year is going to be $140 a barrel. Of course, it doesn't work that way. So speculators tend to be wrong at the turns. Commercials tend to be right. And so it's useful to track what commercials and speculators are doing in the market. And that's something Robert Proctor does if you're interested. Anyway, what else do we have over here that we could look at while we're here? We looked at the dollar briefly. The dollar looks like it's done chopping sideways. I'm expecting the dollar to move into this 105 to 110 area. And if it does that, obviously the euro is going to go down. Gold will probably go down. So things in dollars will go down in value, including stocks. So, keep an eye on the dollar. If the dollar starts to really move, probably what's going to happen is we're not going to move significantly higher in stocks if the dollar tends to move very rapidly. Again, I was expecting this to pull to the bottom of the channel. It didn't. It could go higher from here, but I think at this point in this type of trend, we would have expected to pull back first, and didn't do that. So I think there's still a likelihood of a high, but the high could be limited to this midpoint, line somewhere over here, maybe around 2175 or something like that. So and then we sell off. So we'll just see. We'll see what it does and go from there. In my NinjaTrader platform, I didn't really have any trade setups, but I did want to show you that these are 1 week decision point areas, and you can see the stock. We're trading right in there in the futures, and you can tell how important these are. Look how this was the Brexit sell-off, and we came right into this decision point, which is nothing more than a level that's below this pivot right here. So the way these decision points are, golly, I just don't understand why that's happening. That's not the way that was working before. Something has changed. Anyway, there's a pivot right here. You can see the pivot. See, it's not doing it now. And so this DP here is just an area below this pivot. This whole move right here was down. So this is the most recent pivot from this down move. That's how that works. This whole move right here is down. So what you do is you take a measurement off this pivot. Now the decision point off of this pivot is higher than this one we're looking at. In fact, let's put it in real quick so you'll see what I'm talking about. If I take a decision point off this pivot, it's going to be up here a little higher. Let's pull this down. So I'll click on decision point, click right here. See, we haven't gotten to this one yet. So it's slightly higher. Might hit it next week. Might go through it. Not sure. But you can see that it's just slightly higher. Now I've been talking about dojis and all that. Who knows? Next week maybe we get a doji. Maybe we get something that looks like this, where the market went up, but then the market also went down. And if we get something like that, then that could signal the end of this particular swing from here to here. So this is why you can't predict really the market. You can only talk about where it's likely to turn. Well, it's likely to turn, at a decision point off of this pivot right here. That's just the way it works. Just like the market, when I took a decision point off this pivot, that decision point was right here, that box, and that's where the market turned. So it's likely to turn in this area as well. So be looking for that. And I don't know what that area is. Let's see how much higher that is. That puts us on the futures at like 21.30, 21.35, something like that, which would be a new high. 21. Actually, I don't know what the high on the futures are, but that would definitely be a new high because we're right at the high right now, and it's below the decision point. So if we get to that decision point, it will be a new high in the S&P 500. But not likely in the Wilshire. So you've just got a lot of inconsistencies in the market right now, and eventually they're going to be resolved, but right now there's no way to know how to resolve them. What else? Sorry about the dogs barking there. I think that's really about it. I mean, a lot of the other global markets, I mean, Germany and just the worldwide market in general seems to be mostly in a downtrend. So maybe the U.S. is just the last market to experience a downtrend. We have this election season. The Fed's kind of they're not tightening, they're not easing, they're just doing a lot of jawboning. Hillary Clinton we were just incidentally, we were talking the other day and amongst some people, and somebody made a comment that if they ever got in trouble with the law, that they were going to request that the FBI investigate them. I thought that was pretty funny. It's just incredible that, I mean, I don't know where you are in your politics, but I don't know how you can do so many things wrong and break so many laws and then have, something like the FBI recommend not to prosecute. That's just an amazing. I mean, we are living, the average citizen is not living in the same country that the Clintons live in and the Obamas live in and these other people live in. So I don't know. I don't know what you do about it, but that's the way it is. Trying to think if there's anything else I wanted to discuss. I really don't have. I wish I had the numbers together to show you what, kind of what. Well, I'll tell you what. Let me see if I can pull up. I'll do that. Let me pull up the financial forecast for Elliott Wave this past month, and let's look at. I'll show you what it looks like on gold. This is it right here. So this is a chart of gold. Let me just zoom. Let me get to about right there. That'll be good. And these are commercials, so you can see commercials are net shorts. They're at record shorts. That means the guys that are in the business of mining gold, distributing gold, whatever they do with gold, they're short gold. And speculators, large speculators, are long gold. And anytime you get this kind of divergence between commercials and speculators, when it's that big, that means you're usually at some sort of turning point. So you can see that here. There was a pretty good divergence here between specs and commercials, and look here, market turned. You can see here they were pretty close, and the closeness doesn't tell you as much as the divergence does. So this divergence here is a big divergence, and what I'll do is I'll kind of zoom back in over here so we can see where that goes to. You can see that this span right here corresponds to this peak right up in here. So this is usually a pretty good indicator. It's not so accurate that it works on a particular day or anything like that. But if you're thinking about buying gold, you might want to sit on your hands here for a little bit and wait for these to get a little closer, like right in here. I mean, look how close it was here, and look at what a great buying opportunity that was. I mean, gold was like 1040 or something an ounce right here. So this is a very useful chart. I don't even know how you, I mean, the only reason I see it from time to time is because Prechter reports on it at key inflection points in the market. But if you have access to this information, boy, it sure is useful. And it's only for things like oil and commodities. Think commodities basically, because a commercial, you know, it's got to be in the business. Like Coca-Cola's in the business of making Coca-Cola. Anyway, that's just kind of an anecdotal deal. Thought that was kind of interesting to show. Here's our YouTube channel. Feel free to just go up, to the Internet Explorer deal and copy the link and send it to folks. You can also, let me do Twitter. Let me show you Twitter. Whoops, misspelled something there. Twitter / investor class. That should pull up Twitter. Maybe not. Maybe that won't. Maybe I have to do Twitter / middle class investor. Yeah, so here's a middle class investor Twitter. I try to put some like here you can see. I announced. I said UK leaves the EU and put a YouTube there. Brexit the movie. Thought that was interesting. Here on June 23rd, it looks like Great Britain will wisely choose liberty and self-government. I mean, here on the 21st, I said when the experts are insisting that Brexit would be a disaster, then there's nothing to worry about. So this is kind of my way of saying they're probably going to leave. Anytime you get Obama and all these statists, talking about, oh, it's going to be a disaster if they leave. Well, I don't know who it's going to be a disaster for. Maybe it's going to be a disaster for Europe. I don't see how more freedom for British people is going to be a disaster for British people. That just doesn't make any sense to me. But some people, some people fall for that. So anyway, that's it for the week. I want to look at one more time. Let's look at that 10-year Treasury. Sometimes when you get a big thrust like this, it kind of signals the end of a move, at least an intermediate move. And you can see here we had a big thrust. Here we had a big thrust down. So I don't know. We are very close to the end of this move. Since we were talking about Prechter a minute ago in EWI, he put out a theorist, an Elliott wave theorist. I'll show you that on the bond market. And he's saying, look, this is what he calls a primary wave move in bonds. And this is what's called an ending diagonal. And so a lot of times on an ending diagonal, what happens is when it's done, and it may not be done yet. I mean, that's a possibility. But usually when an ending diagonal ends, this whole move is reversed in pretty rapid form. So to the bottom of this thing right here, this would be actually it would be all the way down here. So you're talking about a move from here all the way down here in pretty rapid order. So, here he shows another version of it. So what happens when an ending diagonal ends, you get a move that wipes out this whole move that started right here. So that means this would go all the way back down to here, like in a matter of, I don't know, a couple months or something, even though it took 8 months to get all the way up here. So just beware, you can lose. By the time you get your statement in the mail, you could have lost a lot of money in a bond fund. So just be aware of that and be careful. And come back next week. We'll have another video presentation, and hopefully here in the next several weeks, the markets are going to start providing a little bit more clarity. You know, when you're in these choppy zones and the markets are not really trending, it's kind of difficult to really say, you know, what's likely to happen. We are at a pivot point, though. We showed that in that NinjaTrader chart. So we're at a pivot point. We could roll over here and go down a little bit, somewhere down in this area. If we do, and it turns back up after we move down to this area, then I think we're going to some higher highs, maybe even the top of this channel. So anyway, that's it for this week, everybody. Thanks a lot for coming in. Feel free to forward the link to friends and family. Follow me on Twitter. All that kind of stuff. I'm trying to do all that kind of stuff. All right? Take care, everybody. Bye-bye.